Hi, and welcome to Jenkins Guard on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, we're back on the frontier. And which frontier is that? Well, it's the research frontier. In this part of the channel, we are taking a closer look at theories and empirical findings to emerge from academic research and highlight that and bring our attention to some of the insights being generated to us for us there. So in this case, it's about how the firms actually hedge. Do we have some empirical evidence on that lets us know how firms actually implement hedging? And what's the role of managers in that? Is it possible that managerial traits and characteristics can be linked to how these hedging strategies are executed? So that's those are the research questions we're going to investigate. And for more on hedging strategies, please consult my book, Corporate Foreign Exchange Risk Management, co-authored with Lars Uxelheim and Alfa Vinesen. There's also more information on my webpage, riskbalancing.se. And as they say here on YouTube, please like and subscribe. So this piece of research here is done by yours truly. Compliments also to my co-authors, Ettore Croci and Alfonso del Giudice, pardon my Italian there. So it was published in Financial Management. And all right, so we're asking some questions here regarding what exactly determines corporate risk management strategies. You know, what are the influencing factors that determine what risk management strategies we end up seeing in the data? And here you have some theories, of course. The most sort of central one in the academic literature, they are concerned about how you can use risk management to create shareholder value. That is taken as the goal of any financial policy. So risk management is investigated from that perspective, and we come up with theories like avoiding underinvestment, because investments are presumably valuable. We want to execute the investment program, and if risk management can help improve the odds that the strategy can be undertaken, well, that's valuable. Also, if you get close to bankruptcy, there are various financial distress costs that make it harder for you to compete and create value. So if risk management can help you avoid that, there's also value. So, but then there's this other strand of research papers dealing with managers' preferences. And this is part of the agency problem, where maybe managerial preferences are not coinciding with those of the principal, the owners of the firm, so that they are primarily using corporate policies, risk management in this case, to protect their own well-being and wealth, to promote those outcome variables rather than value maximization. So it's a different explanation altogether for what determines corporate hedging. Then we have more and more research has been done from this angle, right? Where we're actually looking into very specific and detailed managerial traits, to see if their personalities even matter to corporate policies. And this is one of the more exciting developments in finance research, that we've been able to incorporate these dimensions, whereas earlier it was mostly assumed that companies were value maximizing entities that just neutrally adapted to changing circumstances. Not so now. I mean, there's been research showing how background like serving in a war or having, traumatic experiences, how that affects corporate risk taking later, for example. So it matters a lot who is running the firm and their preferences. And after all, there are people, and when people make policies, right? So it makes sense. So one of the big conclusions to emerge from this research is that firms are absolutely not just these rent maximizing units that respond to dispassionately to whatever is going on outside the firm, So there's great explanatory power from incorporating information about managerial traits here, because it turns out that these characteristics, they matter a lot, and it's been more fun to do research. So for example, we have narcissism being a major factor in corporate policies. So we're going to talk about that in another video. So if you want to understand how firms behave, the actual corporate policies that you see, you do well to look at, behind the behind the facade here, and look at what's the person like. All right, so now we take that and we go to a risk management setting here, and we ask some questions related to that. For example, why do firms hedge? That's the decision to hedge, more or less, which firms engage in risk management at all, and some prefer not to. So there's an outcome you can try to explain. This is a phenomenon that can be explained to a fair extent with empirical models if you find the right variables from theory then, and you can also measure how much they hedge. Like if you have a hedge ratio of some sort, which is the hedge volume through the exposed volume, that's also an indicator of the degree to which the firm is doing risk management intensity. That we put some proxy for risk management intensity as a dependent variable. So that's why firms hedge. Another less investigated strand of research is how firms hedge. And now we're talking option-based versus linear hedging strategies, and how those are financed, because it turns out that if you're using options, you have to pay for that somehow. So you can either use cash at hand or sell or write derivative liabilities, short positions, to generate a cash inflow that will help you finance your purchase of a put option, for example. So these are elements of how firms hedge. You can construct your portfolio in so many ways. It turns out that the flexibility is almost unlimited. You have these basic strategies like buying a put option or entering a forward contract, but then you can create combinations, composite derivative strategies, and this is just the beginning of it. I mean, use a little bit of your imagination, and you can design any sort of risk return payoff from basically or using one of these derivative portfolios, because the flexibility is enormous in the sense of choosing strike prices, hedge volumes, and maturities, and it's just incredible the flexibility afforded by these derivative contracts. So when you look at it from the firm's point of view, when there's an underlying exposure, the curves look a little bit different here, but so we're assuming 100% hedge ratio here, combining the underlying performance and the hedge portfolio. So it's the same strategy, except it includes operating performance. So again, you can modify, in this case, corporate performance. So it's not just the payoff of the derivative portfolio, this is combined with corporate performance. So this is where we start seeing that, okay, we can actually fine tune this payoff structure as much as we would like. And like I said, this is less investigated because there are data issues. It takes some fairly granular, sophisticated data to get there. Time consuming, has to be hand collected. So we're actually we have a handful of papers into this, but the promise of it is that there are lots of insights to be had. We need to move beyond the hedge ratio, because that has been explored, and the decision to hedge, for sure, we know quite a bit about that, but we have not reached the point where we can say that we have a solid understanding of what determines how firms hedge. So we go there with this kind of data, and we can have some more insights, right? So why exactly would firms prefer a certain combination of derivatives over another? So if you have some data on that, you can investigate and link firm characteristics, and as we will do, managerial characteristics to that decision. So the argument in the theory of it is that option-based hedging strategies are superior whenever there's a non-linear risk exposure. So for example, you can get that if there's a correlation between volume and price risk. So you're hedging the price risk, but it's significantly correlated with volume risk. That gives rise to non-linear behavior, and perhaps making you prefer options then. And also volumes can be uncertain, and so that maybe they end up not materializing, so you're uncovered, and with the options you can walk away, you have more flexibility then, and don't risk over hedging. There are also theories related to financial status, so that for example, if you're financially weak, you have cash is a scarce resource for you, then paying the put option will be problematic, because maybe you need to take money away from the investment program for that, and there's going to be a cost to it. And whereas maybe financially strong firms then prefer these out of the money put options, because it gives them protection against the downside, but they are able to preserve much of the upside, which is normally the preference of most firms. So this is the theoretical background, and we're investigating this empirically now. Which of these theories are holding up best when examined using actual real-world data? And we're asking specifically if managerial preferences matter. Are they going to have explanatory power for the patterns in the data? Can we discriminate between hedging strategies based on what the managers of the firm are like? So we developed in this paper some hypotheses. The managerial risk incentives hypothesis is it is simple, but maybe it sounds complex here. But if managers are rewarded using non-linear payoff structures, well, they have an interest in preserving the upside potential, because that's where when their own options, I mean, we're talking stock-based compensation here. They get stocks and options in compensation, referring to their own stock price. And those will get more valuable if the stock price or the short-term performance takes off. So there's upside for them from that. So why would they hedge then in that case? So if they hedge at all, they would look for hedging strategies that don't cap the strategy upside potential. So that, for example, linear hedging then would cap upside the most and be the least preferred by these managers, because it would go against their own interest to hedge with linear instruments. Because here, if you hedge, you have a linear sort of development in corporate performance as proxied by the hedgeable risk factor. I mean, the more the risk factor develops positively, the better for the firm's performance, we're assuming in this case. With hedging, it becomes linear because you cap the upside potential. So you don't stand to benefit as much as a manager. We have managerial compensation here on this axis, so it doesn't take off. Whereas if you leave it unhedged and the underlying risk factor develops positively, boom, there's you cash in on the options and these earnings per share targets where there's a bonus attached to it, and that's good, right? Because now managerial compensation is much higher. So what kind of compensation package then would create this sort of convex non-linear payoff for managers? Well, there has to be non-linearity, and usually that comes from various kinds of options, right? They are only in the money if a certain threshold is reached, the strike price is reached. So you are going to try to avoid anything that lowers the probability that you reach the strike price. So bonuses and the likes would be only paid out if the threshold is reached. So it's non-linear. So we're putting out more hypothesis into the mix. We're saying that there's a quiet life dimension here, that older CEOs, they don't like distress and uncertainty because it's more taxing on people. It's very stressful, and they are more attached to the organization, maybe because they've worked there for a long time. They have a legacy that they're concerned. They don't want to walk out on the firm in a crisis and leave it in a big mess, So there's a strain from all that older CEOs are perhaps less able to cope with. So and also if you're close to retirement, then same thing. There would be more hedging to protect against these shocks that could send performance down the drain, right? And because of these legacy concerns and the stress from that. So that predicts more hedging in firms with older CEOs and those nearing retirement specifically. So you would expect to see a preference for linear hedging instruments because they create the most certainty. But there's also a career risk hypothesis. Younger CEOs in this, according to this hypothesis, are more averse to financial distress and uncertainty because it would damage their reputation, and they have a longer career to look forward to. So if you suffer an impaired reputation early on, the net present value effect of that can be quite large. They suffer the consequences over a longer time horizon. So it's the opposite here now. It's the younger CEOs who prefer more certainty and less risk and more linear hedging, because the hedging intensity is larger for these instruments than options, right? So that's another expectations altogether. So it's an empirical matter which dominates. So we do collect lots of data here. We have 500 hand-collected observations on derivative portfolios. So here's one three-way collar where they sell forward certain amounts, they buy put options for some volumes, and they sell put options for another volume. So it's a mix of things, and we just code that. We code what we see into usable observations in our statistical packages, right? So, and then we investigate. So some of the things we find, linear strategies are absolutely the most common, but collars are also very popular among firms. Some 39% of firm years we see that. Cash finance put options are relatively rare, less than 10%. So that strategy, while talked about a lot in academic research, is actually rare in practice. Much more preferred to sell some put options to finance them than use cash on hand, because managers are reluctant to depart with their cash and prefer to sell some upside, but writing call options, for example. So we code a variable here on the left-hand side. It's a dependent variable. It takes a one, depending on which strategy we observe for that firm in that year. And this is the dominant strategy. Like if they predominantly use a collar strategy, it's coded as a 2. And if it's predominantly a linear strategy, it's a 3, and so on. So we can create a variable capturing hedging strategy. And then we have variables capturing risk attitudes. Like this refers to the risk incentive hypothesis. So that Vega, this measure, captures how many, the sensitivity of your stock portfolio. So that the more stocks you have, you want to protect that, and you're risk averse, according to the theory. So that if this is a large number, you would have more hedging intensity. And Delta, on the other hand, captures the nonlinear aspects of compensation packages, so that a manager with lots of a large option component in the compensation package would have a high delta, and they would prefer hedging strategies that do not cap upside potential. All right. And then COH is also here, but that is self-explanatory. All right, so we run regressions on this, trying to explain then hedging strategy using these variables. Unfortunately, we always hope for some stars as researchers, but there are none on Vega and Delta here, so the risk incentive hypothesis is not supported. There is some support for age, though, COH. Firms are more likely to engage in certain kinds of strategies the older they are. And there's, here's the basis, non-hedging as the base category here. So we see that all forms of hedging increase in likelihood if the older the CEO gets, indicating risk aversion on their part, right? And as they get closer to retirement, there's also a preference for linear instrument. So there's more hedging intensity using linear instruments the closer you are to retirement. So that hypothesis is supported. And we're able to see also that the probability of doing hedging in the first place is also positively correlated to age. So they seem to go for more hedging and more hedging intense strategies. But we have to conclude that there's no support for managerial risk incentive theory, despite the impeccable logic here. There's no obvious connection between option-based CEO compensation and the hedging strategies that we see. I mean, more evidence is obviously needed, as we like to say, but in this piece of research, there was no support for that theory. We do find support, however, for the quiet life hypothesis. The older CEOs are, and the closer they are to retirement, they increase hedging intensity. So it's one of those cases where managerial traits matter, like who is running the firm, and this is not necessarily value optimization, it's CEO utility optimization. So the quiet life hypothesis is supported because these strategies are bringing more certainty. So how firms hedge is under-researched. We've hand-collected data that allows us to pursue this and explore, the reality of hedging strategies. We find that, we would expect them to do less hedging that caps upside potential if they have incentives to that effect from the compensation package in the form of options. We don't see that in the data. However, we do find them support for the quiet life hypothesis. So you can expect more hedging intensity in firms where the CEO is older. So we can sort of predict more hedging in those firms. And we have learned about hedging behavior now, how this, the lay of the land in this area. And those are things you can do with data, test the theories. All right, thanks for listening. And please consult my books for more information. Respecting.se, also more information. Please like and subscribe. Have a good day.